So Gabe, the other question that I get a lot, FHA loans are very popular right now, and clients like FHA loans, but they also get a little bit worried about the mortgage insurance that comes along with an FHA loan. So can you speak to that? What does it mean, and how does it get applied?
Sure. CJ, as a general rule of thumb, lenders require that a borrower pay mortgage insurance if they have less than 20% as a down payment when first buying a house. So that's the first rule of thumb. 20% down, less than 20% down requires mortgage insurance. So in answering your question specifically with FHA loans are designed for low down payment financing options with as low as 3.5% down. So with FHA loans, there's two types of mortgage insurance. There's what's called upfront mortgage insurance, which currently is 1% of the loan amount, and it can be financed into the loan, meaning it's added to the loan amount, and you don't have to pay that as part of the closing costs. And then there's a second type of mortgage insurance, which is a reoccurring mortgage insurance, and it's paid monthly. So overall, again, FHA loans have two types of mortgage insurance. The mortgage insurance insures the lender. So in fact, it's not insuring the borrower or the buyer at all. It is insuring the lender in case of default. So again, the logic behind it from lenders is to say that if you put less than 20% down, statistically speaking, there's a higher chance of default. So therefore, we're charging this insurance policy to protect us as the lender. In almost all cases, mortgage insurance you can get rid of mortgage insurance when your loan reaches 78% of the value of your home. Now, that's a general rule of thumb. Many lenders and different types of loans interpret it differently based on the current value, based on the original acquisition cost, and so forth. But as a general rule of thumb, once your loan reaches 78% of your home's value, that's when you can petition to your lender to get rid of the mortgage insurance.
More about mortgage insurance. Can you tell me how mortgage insurance is calculated on a loan?
Sure, CJ. The FHA monthly mortgage insurance is calculated based on a factor of either 0.85% or 0.9%. That factor is derived by a formula that the Federal Housing Administration has, which is determined based on many risk factors like loan amount, down payment, credit score, and so forth. So once the factor is determined, if it's either 0.85% or 0.9%, you take that factor times the loan amount and divide it by 12 months, and that's the monthly mortgage insurance premium.
What are some of the advantages of FHA loans that might help them balance the idea of paying a monthly mortgage insurance?
Well, CJ, I understand overall many people don't want to pay mortgage insurance. For most people, there's no tax advantage. It doesn't protect the consumer. It protects the lender. So I understand the reasons for not wanting to pay it. However, in many cases, the people who are getting an FHA loan couldn't otherwise get a loan. So it's either you pay the mortgage insurance and get the house, or you don't get a loan. So that's definitely something that we take into consideration. As an example, FHA only requires 3.5% as a down payment. So in cases where people have a low down payment option, FHA is the only real option. Additionally, FHA allows for lower credit scores for people to qualify where they otherwise may not. Third, it allows for the down payment, whether it's 3.5% or 5% or whatever, it can come from a gift from a family member, or it can be a loan against their 401k. And again, in many cases, that cannot be the case in non-FHA loans. Additionally, you can, if negotiated in the contract, get up to a 6% credit from the seller toward your closing costs. And again, in many cases, that's not allowed on other loans that are not FHA. So the one other thing is a consumer can actually have a bankruptcy as recently as 24 months ago or more. And on non-FHA loans, minimum requirement is 4 years or 48 months a waiting period after a bankruptcy. So again, there's a lot of flexibility in FHA loans that may allow a client to get a loan where otherwise they wouldn't. And lastly, I've seen cases where FHA loans actually have lower interest rates than a non-FHA loan, whether it's conforming loan or non-conforming loan, where lenders can offset the risk because they are charging the mortgage insurance. So there's a lot of flexibility on FHA loans, and so we have to look past that mortgage insurance sometimes.
One of the things I hear a lot from clients is that they don't want to necessarily call up the loan officer because they're afraid they're going to get into a major commitment, but they do have questions about loans and mortgages and rates and prices and so on, etc. Gabe, can you tell us, how do you help a new client or someone who just wants to ask a question about it? I mean, how do you deal with that, and how do they get a hold of you?
Sure. Well, the way I work is ultimately that I have no problem speaking with a client about their own personal situation. I do complimentary consultations over the phone or in person, through email. And be happy to ask some questions about clients regarding their current situation, their goals, their risk tolerances, and ultimately determine what they're trying to accomplish. Before I even take a loan application from a client, I would certainly like to know more information. So if somebody is interested, somebody has generic or general questions about their situation or what options are available, absolutely, you can contact me, again, by phone directly, 408-426-4416, or you can go to my website or email me, and that's www.bayareahomefinancing.com.
Thank you, Gabe. It's always great to talk with you.
Thank you, CJ.